Imagine one of Nigeria's biggest fuel importers pulling back and a mega refinery quietly ramping up to take over the market. The sudden switch in Nigeria's fuel market. Oando plc, a major Nigerian energy company, has announced that it will suspend petrol imports, citing a sharp drop in premium motor spirit, PMS, import volumes due to the rising output of Dangote Petroleum Refinery. In the company's unaudited H1 and 9-month 2025 financial report to 30 September 2025, Oando said its trading segment faced major headwinds. Revenue for the first 9 months fell by about 20% year-on-year, from 3.2 trillion naira in 2024 to around 2.5 trillion naira in 2025. Oando attributed the decline primarily to the decrease in gasoline imports, which was itself caused by the ramp-up of the Dangote Refinery. It described this as, I quote, positive development that enhances Nigeria's energy security and self-sufficiency. Across its business, Oando said it is shifting strategy. It paused PMS, petrol trading, diversified into LNG, liquefied natural gas, metals, and crude oil export/trading to mitigate the impact of shrinking import volumes. Why this shift is significant? End of massive petrol import dependence. For decades, Nigeria imported large quantities of petrol because its domestic refining capacity was minimal. With Dangote's output rising, importers like Oando are rethinking their strategy. Dangote Refinery ramping up. According to other sources, Dangote's refinery is now supplying tens of millions of liters of petrol and diesel daily, reportedly 45 million liters of petrol and 25 million liters of diesel, which exceeds national demand. This means the domestic supply chain is shifting. Import-reliant marketers now face a market where local production is gaining dominance. Market consolidation and strategic repositioning. Oando's pause in petrol imports suggests large marketers must adapt or exit. The company redirected its focus to upstream crude trading, LNG, and metals, activities less exposed to the domestic petrol import squeeze. Impacts on consumers and energy security. With robust local refining coming online and imports shrinking, Nigeria could see better fuel supply stability, fewer shortages, and perhaps reduced dependence on foreign supply shocks. The driving forces behind the shift: import duty and policy support. The Nigerian government recently approved a 15% import duty on petrol and diesel to support domestic refining. This policy change increases the landed costs of imports and gives local refiners a competitive edge. Economics of local refining. When domestic production rises, the logic of importing petrol at high cost weakens. Hence, firms like Oando are reworking strategy. Realignment of petroleum trading business. When the market structure changes, that is, that local refining begins to satisfy demand, traders must pivot, and Oando's movement into LNG and metals is an example. Energy security and self-sufficiency goals. Nigeria has set a goal of ending petrol imports. This shift suggests progress is being made on that front. Challenges and risks ahead. Scaling local production reliably. While Dangote's output claims are large, maintaining consistent production, refining margins, logistics, and distribution remain complex. If domestic supply falters, shortages may resurface. Importers exit and market competition. If importers pause or leave, marketers say competition may decrease, raising risk of pricing power shifting towards refiners or oligopolies. This could hurt consumers if not regulated. Price dynamics. Even with local supply rising, retail petrol prices depend on many factors: exchange rate, crude price, logistical cost, state taxes. A shift in supply source does not guarantee lower pump prices yet. Downstream disruption. Companies like Oando experiencing revenue hits show the disruption in the value chain. Not all firms may adapt successfully to the new environment. Regulatory oversight. As the downstream market transforms, regulators must guard against abuses, ensure fair access for marketers, prevent monopoly, and safeguard consumer interests. What to watch in the coming months? Oando's full exit or re-entry. Will Oando resume petrol imports if margin conditions change, or will it fully pivot to upstream LNG metal sectors? Marketer behavior. Will other import-reliant marketers follow suit? How will filling stations respond in terms of pricing and availability? Pump price trends. Are consumers seeing reductions or at least stabilization in petrol prices? Are there fewer queues or supply disruptions? Refinery output versus demand balance. Is Dangote's production truly exceeding national demand? Will imports fall significantly? Policy and regulation movements. Will lawmakers or regulators adjust rules to ensure fair competition? Will import duties or tariffs be modified? Impact on national fuel security. Will Nigeria begin exporting refined products, or will it still need imports in certain segments like aviation fuel or specialty products? Implications for stakeholders. For consumers, this could mean greater fuel supply stability, fewer shortages, and potentially lower costs if the pass-through is effective. But vigilance is key. Supply can still be disrupted by logistics or upstream issues. For marketers, import-dependent firms face structural challenge. They must either compete with local production by cutting cost aggressively or pivot their business model, as Oando is doing. For the government, this is a policy win: rising local production, reduced import bills, improved energy security. But the government must ensure the market remains competitive, efficient, and fair. For investors, the downstream sector is in flux. Large investments in refining, local production growth, shifting trade flows, opportunities exist. Example, refined product exports, logistics, feedstock supply. But risk is higher for failing firms. Final reflections. The slowdown of petrol imports by major players like Oando, triggered by the ramp-up of domestic refining at the Dangote facility, may mark a turning point in Nigeria's fuel economy. What once seemed a distant goal, energy independence, appears to be edging closer to reality. However, transformation is rarely smooth. The value chain will need to adjust, marketer participants must reposition, and the government must ensure that benefits reach the end consumer rather than get trapped in new monopolies. For ordinary Nigerians, the important question remains: will this translate to steady supply, fewer queues, better quality, and lower or stable petrol prices? If yes, then this moment might rank as one of the more meaningful changes in Nigeria's downstream oil history. If not, then importers suspending business might turn into a signal of emerging market distortion rather than triumph. Time will tell, but the story is unfolding.
Thanks for watching. If you enjoyed this update and want to stay informed with fast, reliable news, don't forget to subscribe to Newsflash 360. Hit the notification bell so you never miss a story. Your next headline is just seconds away.